Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network.
Before we get into today's show, there are a few things we have to go over.
Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you'd get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program.
Ashley, thanks for taking some time to join me, mate.
It's a pleasure to be here, Owen. Thanks for having me.
Yeah, it's my treat. We're going to explore, I guess, a sector and a subsector that we have never explored before. So I was trying to, as I was just mentioning to you, I was trying to explain this to my old man this morning while we were having a coffee. And I could just see him connecting dots and be like, oh, wow, like this is a whole thing that I never knew existed. So I think anyone that listens to this is going to have that same reaction. Mm-hmm. And I'm hoping, and I know you will be a good field guide for this, but let's talk a little bit about, let's do some icebreakers to begin with. So one kind of quirky question I ask guests is, if you could have one skill, whatever it might be martial arts, it could be another language, something like that, what would you choose?
One skill, I mean, I think about this, so it'd be nice to be able to dunk in basketball, I'm a basketball player. I think at the age of 45 and 5'11", that's probably unrealistic. Another thing work-wise would be great to have, a photographic memory. Again, probably unrealistic. But I think a more realistic one is the importance of maintaining balance in life. And I see that as a skill, right? And so a wise person once told me there's 3 key areas of life. You've got relationships, career, and your well-being. And in terms of your relationships, for me, it's like my wonderful wife. I've got 4 kids between 15 years of age and 6 months old, obviously balancing that. From a career perspective, it's your job, your education, your development, etc. And then well-being, both physical and mental. And on the physical side, things for me like running, cycling, weights, basketball. So coming back to the skill, it's about how do you balance those 3 categories within life to make sure you're giving appropriate attention to each of them to have, fulfillment and happiness and productivity across a balanced life. So that would be great to be able to master the skill of maintaining that balance, which is it's a constant challenge when you're juggling 4 kids in a career.
Oh, absolutely. I mean, I don't have kids, but I can only imagine. Yeah, you're dealing with that this morning, then you come in here on the train, which you said was delayed, jump into the studio and we're talking about senior secured loans and to thousands of listeners. So
it's funny. I joked recently with friends and family that on one end of the spectrum, I'm taking my 15-year-old to her casual shift at a Mexican restaurant, and on the other side, changing nappies of my 6-month-old boy. So it's you get the whole spectrum these days.
For sure. And you've got the career sorted as well.
Yeah.
But I guess maybe dunking is probably equally as impressive in some respects. So at 5'11".
I wish I could. No, my specialty is more 3-pointers in basketball, but I've never been able to dunk, but I don't think it's going to happen. It would be nice.
Never say never, mate.
Without a mini trampoline anyway.
Okay, so one icebreaker for the finance side of things. Mm-hmm. If you could describe the macro environment right now, as succinctly as you can, how would you do that?
Yeah, so I mean, I think this is an obvious answer, but we're facing a variety of dilemmas that we never have before in combination. You've got obviously inflationary pressures, you've got the velocity of rate rises, the recessionary risks that are now coming through, as well as at the same time having geopolitical risks and war going on whilst we're trying to come out of a global pandemic. It's not something that we've faced as investors or as policymakers before. And so that's really challenging for policymakers in terms of balancing that, and obviously they're favouring controlling inflation potentially at the expense of creating a recession. And what that means for investors is I think that it's rarely been more challenging as an investor to figure out where to allocate your exposures or your risk within a portfolio.
Yeah, I like that answer. There's so many big rocks that we're trying to move, right? It's interesting to hear people's narrative around why those things are important and why other things aren't. And I think for me personally, the the viewies just to get as many views as you can and see what kind of interesting nuggets different people have. I'm sure we'll cover some of those in a few moments, but I got a kind of another question, which is more of an icebreaker, which is around risk-adjusted returns and asset classes. You're obviously someone who gets exposure to a lot of different asset classes. You talk, you research, you do all these types of things. What would you say are some of the most compelling risk-adjusted asset classes? And maybe we can cut it in two for, say, retirees in that bucket and maybe accumulators in another bucket.
Yep. Well, let me start with the accumulators then. So as an accumulator, I think about somebody that can take a longer term view, be more focused on total returns, and potentially take illiquidity risk. And for me, through my career, through decades, the most proven asset class from a risk-adjusted return basis is your real assets. So I'm talking about unlisted global property, unlisted infrastructure, where you can get, very stable cash flows, good total returns, low volatility from investing in a diversified portfolio of high-quality direct real estate or infrastructure assets. I think that's been proven over decades. And if you're talking about taking a 10-year plus view, then I think that's a good exposure to have within portfolios as an accumulator. For retirees, where you're thinking more about perhaps a shorter term time frame, income's a focus, you need liquidity, then the asset class that we're here to talk about today, senior secured loans, I think is a great fit for retirees, given you can get, over the long term, you're talking about cash plus 4% type total returns, which is only just shy of the equity risk premium of cash plus 5. So you're near equity-like returns whilst being senior secured, so safest part of the capital structure, having much lower volatility than equities, and having, importantly for retirees, very stable monthly income in an asset class that's been proven to be liquid for over 30 years. I would also mention that this asset class of loans that we're here to talk about is also relevant for accumulators, but I gave the answer around more real assets there, given the long-term time frame.
It's interesting how you slice those up. And I feel like, particularly with the real assets, because it's for accumulators, I feel like a lot of us, I think, and I was talking to you about this off air, I think the lines between public and private and real direct assets is going to become a lot more. I guess the line's going to be blurred because people are going to realize that, hold on a second, I can get this exposure many different ways now, and there's so many opportunities to access those marketplaces, which maybe 30 years ago was very hard. And I mean, you've seen this for years, as you said, but say for me, someone who deals with a lot of retail investors, self-directed investors, even advisors to an extent, are now seeing more of this line up and the opportunity set come to market, which is really interesting.
Yeah, I think it's great to see that the level playing field that's now occurring across institutional and wholesale or retail investors. My background before joining Invesco was in more the institutional side, so advising industry super funds, and so they've been investing in real assets and private markets for decades and had great success out of that. But managers like ourselves and others over the last decade have been focusing on how that can be brought to the same quality of investment opportunities and assets be brought to the wholesale or retail market. And so I think that's great to be able to have that diversity.
For sure it is. And we're going to get to, if you're a bit confused about senior secured loans and you're listening or watching, we'll get to that in just a moment. But maybe to start with, just a little bit of background on you and how you came to be involved at Invesco, I think is really interesting. And kind of if you can fill us in on what you kind of do every day, which I think is really neat as well.
Yeah. Well, if I was thinking about this, who sort of shaped my career, I think it starts with your parents, right? My father, accounting and business background, so very much followed in his footsteps, and my mother was a dressmaker and teacher, and so they combined those skills into creating their own business that they ran out of our basement and grew into a successful importing and wholesale business over time, whilst driving me and my two brothers around the state to play basketball. And so I suppose I learned from that about the importance of a strong work ethic, focusing on what you're good at, what value you can bring to clients or colleagues, and the importance of compromise and sacrifice for family. And so my dad still helps out the family on the accounting side in retirement, and my mum's she's knitted over 600 woolen blankets for charity for kids in need in their retirement. And so that, constant giving. So that for many people, your parents obviously influence you. But in terms of career, the three key people I'd highlight is in high school, the accounting and economics teacher who was also our first basketball coach as well as our careers advisor. I asked him on the careers advisory front, I'm interested in commerce, but my strengths are in mathematics. What should I look at? And he mentioned actuarial, which I'd never heard of before, never contemplated. I ended up studying in that field and working in it for a couple of years, which was great. Grounding in attention to detail and, sense checking, being able to identify when numbers don't look right. But it was never for me longer term. And then I ended up spending 10 years at Frontier Advisors, who advised the, mainly industry super funds in. So I was working as head of debt and covered multiple asset classes and consulted to clients. But the key influence there on my career was Fiona Trafford-Walker, who's, one of the best known consultants in the industry. She was head of the business and head of consulting at the time, and I was privileged to work under her on some of the small to mid-sized clients that we had there, and had the opportunity to write investment committee papers, present at investment committees. And one of the lines she used to say, we had held an annual manager function where managers like Invesco and our competitors came along to hear about what Frontier was and their clients were focused on. She used to say to the managers, remember, there's thousands of you. At the time, there's only 60 employees at Frontier. Bring us your best. Bring us what you'd put your mother in. So in other words, just don't bother bringing us something that's average. Don't bother bringing us something we've already got. Bring us an investment strategy or capability that you are genuinely good at, that you would put your own mother in. And that stuck with me through my career in terms of really focusing and being honest about what you're good at and what you're not good at from an investment perspective. And then finally, Invesco, we're discussing earlier, Marty Frank, the CEO in Australia, we've known each other for close to 20 years and met down at the Launceston Cup, actually. We met, we had a mutual client down there, and we were there for a horse racing event. And I met him, and we were discussing, industry dynamics and insights around various relationships in the industry. And I just found that I never had this feeling in my life, like, I want to work with this guy someday. And he was Sydney, I was Melbourne-based, but ultimately when he moved down to Melbourne for the CEO role, we co-created the role that I now have, which has great variety to it, which is, combining my background in manager research and client consulting to identify what strategies we should bring to market on the investment side and how to best communicate with them in market to make sure that our clients and researchers have the information that they need, those sorts of things. And so Marty, he's a phenomenal sales and relationship guy, but also a born leader. And it's been a privilege to watch the way that he's built the business locally here, and learn a lot from him about leadership and the importance of external and internal relationships and the like. So they're the sort of the main influences on my career.
It's really interesting hearing you talk about that. I find that we often don't take enough time to acknowledge a lot of those people in our careers or in our personal life, and it's not until we're asked a question like this and you reflect on it and you think, oh well, these are the people that have really influenced me. And particularly as a young investor myself, I remember doing that list just like you did, and I remember writing down all the people that have influenced me in different ways, and I found that really interesting in that it just gave me a chance to pause and be like, well, what are the things that these people do that I admire about them, and what can I replicate?
Yeah.
And that was a really good opportunity just to think, okay, I can incorporate some of what they're doing, what she's doing, what he's doing, to make me a better person. And we don't, well, at least for me, I didn't really appreciate that until I stopped and thought about it really intensely.
Yeah.
One of the asset class that we're going to talk about today, in particular, sub asset class, is senior secured loans. But maybe just to set the scene before we dive into what they are, can you just walk us through, I guess, how you see the differences between private markets and public markets? We spend a lot of time in public on the equity side, but then there's the other side of the ledger, and then there's private markets as well. So I think however you want to frame this, so then we can lead into talking about senior secured loans, where they sit and so on.
Yep.
This will set the scene for the rest of the conversation.
Yep. Let's start off by talking about what senior secured loans are. So you're talking about senior secured loans to corporates, mainly in the US and Europe. And by senior, meaning at the top of the capital structure, secured, meaning you're backed by the company's assets. And that's in contrast to equities, where you're at the lowest or riskiest part of the capital structure and not backed by the company's assets. So if I draw the contrast or parallel with equities, senior secured loans and equities, in both instances, you're talking about exposure to corporates, but it's just at a different part of the capital structure. In the case as an equity investor, you're looking to build probably a concentrated portfolio of your best ideas of shares, and you're looking to identify winners, right, that are going to grow over time. As a senior secured loan or a debt investor, you're probably looking for a much more diversified portfolio as a credit investor. I'll explain why later. But most importantly, you're not looking for winners, you're looking to avoid losers, right? Because at the end of the day, as a debt investor, you're handing over $100 of principal, you want to get your regular income, and at the end of that time, you want to get your $100 back, right? So that's sort of the parallel, that you're still, in both instances, investing in corporates and taking on corporate risk or exposure, but just doing it at a different part of the capital structure to get a different outcome. As an equities investor, you're getting higher total returns, more volatility. As a senior secured loan investor, you're getting stable monthly income, much lower volatility.
So how would these sit? So I guess I got a lot of questions about this, but one of the ones is, when you got a senior secured loan, what type of assets are they? And the corporates, can you give us a sense of, I guess, the makeup of the industry? Are you only lending to company, or are you only buying, making these loans to companies of a certain size by revenue? Like, how do you think about that, the makeup of the industry?
Yeah, so it's a very well-established market. So it's about US $1.8 trillion globally across the US and Europe. So a huge market. You're talking about 1,500 issuers or 1,500 different corporates, and across a variety of industries. That's one of the great benefits relative to Australia, where we're obviously dominated by banks, miners, and residential property type exposures, that this asset class is much more diversified across industries. So about 20 different industries, the largest industry exposures in the order of 10 to 15% through time. So you've got things like information technology, equipment receivables, etc., or services. So it's greater diversity by industry. And in terms of the size of the corporates, they're quite large corporates. We're talking about multi-billion-dollar, in US dollar terms, enterprise value companies. So it's at the large sort of liquid end of the market, and in many instances they're globally recognised brands, well-known names. Some examples from the past that have issued senior secured loans are Burger King, Dell, some of the major airlines like American Airlines, United Airlines, Hilton on the hotels side, and Callaway Golf. So that they're well-known global brands, but it may be they're going through some form of restructure or acquisition that means they want to access a certain amount of debt within their capital structure and access the senior secured loan market.
So then what, I guess you mentioned 4% on the bank bill rate, basically, is how people can think about that. Can you maybe make that juxtaposition again with equities? So you're saying the equity risk premium is about 6?
Cash plus 5 normally. Over the very long term, there's plenty of evidence to show that for equities, you typically get about cash plus 5. So cash as in risk-free rate plus a 5% illiquidity, sorry, 5% risk premium on top of the cash rate. Obviously it can be a volatile ride. Some years you can have 25% positives, other years you can have, a significant negative return. So, but over the very long term, it's about cash plus 5. And this asset class over the very long term is around about cash plus 4. And that is generated by, the senior secured loans you're investing in pay a spread above the reference rate to compensate you for the risk that you're taking on. And so those spreads are typically between about 3 and 5%, depending on the risk of the corporate. So over the long term, you expect sort of cash plus 4.
I remember not too long ago, I tried to do this as kind of like a matter of a rigor. Just every year I try and calculate the equity risk premium for myself. I think late last year, I think it was about 5.6 is what I calculated. That was over 20 years in Australia.
Yeah.
That's for equities, obviously.
Yeah.
So then I guess the other question is, so that's really interesting because rates are up, like cash rates up globally. So that's all of a sudden becoming really interesting. The whole fixed income side is now becoming really interesting, whereas the last 5 years it kind of hasn't been, for a lot of investors at least. So I guess the other side of that question is, like, that's maybe the return profile if we think about it that way. But then what's the risk profile? So how do these senior secured loans tend to go with things like default rates? And can you give us some context around that?
Yeah. Maybe before we get into defaults, let me just recap on sort of the key features of the asset class. So you got your high income, you got monthly stable income. It's currently about 7% per annum and growing. Interestingly, because of the current price of the market at 92 cents in the dollar, your all-in yield over a 3 year is about 11% per annum. So you're getting some very strong, consistent income, but a good sort of total yield over a 3 year view. So that's the first point, is your high income. Secondly, the fact that you are floating rate. And by that, it means your income rises as interest rates rise, which provides you protection against inflation. And the third key feature we've talked about a bit is senior secured status, so being the safest part of the capital structure, which means in the event of default, which is your question, so you've got great protection. So on average, you can't get 7% income and 11% total yield without taking on risk, right?
Taking some risk.
So the risk in this asset class is very much corporate exposure. However, you are at the below investment grade end of the credit rating spectrum. And so the fact that you are senior secured provides great comfort around that. It's been going for over 30 years, so you know what to expect. So to give you some numbers around that, on average through time, you have about 2.5% defaults in the asset class, but because you are top of the capital structure backed by the company's assets, on average you have about 60 to 70 cents in the dollar back on recovery. So you're only losing sort of 30 to 40 cents in the dollar, which is a lot less than you are as a subordinated high yield or an equity investor. So what that means, if you multiply that through, on average through time, your actual credit loss is about 0.9%. And if you think you're getting paid spreads of 3 to 5% above cash to compensate you for that 0.9% credit risk, it's actually a very good compensation and risk-adjusted return outcome as a result of that. And so if you come back to that parallel I was drawing with equities. So equities, you are investing in what people would perceive as high quality companies from their in terms of their credit rating, but you're investing in the riskiest part of the capital structure, the first person to lose money if things go wrong.
Yep.
In the case of senior secured loans, you are investing in below investment grade corporates, so riskier corporates from a credit rating perspective, because they have more leverage in their balance sheet, more debt. However, you're investing at the safest part of the capital structure. And the outcome is that senior secured loans is considerably lower risk than equities, despite being lower quality from a credit rating perspective, if that makes sense.
Yeah, so that makes a lot of sense. So how does it work with credit ratings themselves? Do these corporates have credit ratings, or do they I've heard before that maybe a lot of them don't need to be rated, or these types of things, like it doesn't really matter because the assets are secured. How do you think about that?
So in this particular segment, it is rated in the vast majority of instances. So as I said, they're rated below investment grade, but the vast majority of the universe and what we invest in is at the high quality end of that spectrum, so double B to single B in rating. But it goes all the way down to triple C, which are lower exposures. Yep. But at the end of the day, it's about, are you getting compensated for the risk you're taking on, and what's your probability of default, what's recovery on default based on the assets that you're secured against. No,
that makes sense. So because you've got the assets backing those, and like you said before, they're not tiny companies. It's not like you're financing the local cafe's coffee machine or something like that.
Yeah.
So I guess the other part of this is, how do investors typically get exposure to this?
Yeah, so typically via a managed fund. So one of the great benefits of this asset class is that it is genuinely liquid. So for over 30 years, it's been proven to be highly liquid even during the GFC and COVID, although it's privately traded over the counter. To give you an example, typically the annual secondary trading volumes are around about 2/3 of the market size, and so it's a highly traded market with daily liquidity. That then allows the managed fund structures that are on offer from ourselves and others to be daily price, daily liquidity, and typically for Australian investors, it's accessed via Australian feeder into a large overseas pool of assets that are diversified across industries. So that level of liquidity is very rare in private markets, right? Normally in private markets, you've got long-term lockups or you've got monthly or quarterly liquidity. So to have daily liquidity in this asset class is a great feature.
One of the things that I heard is that obviously we've been through the dot-com crash, which was, for some investors, that was a very different experience to the GFC, which was a financial crisis, right?
Mm-hmm.
And then we had COVID, and now people are thinking, as we stare into 2023, what's happened in the US recession, thinking alarm bells there. How does what we are seeing now in this asset class compare to what happened in the GFC?
Yeah, so as I said, the asset class has been going for over 30 years. There's really two periods where there was short-lived mark-to-market sort of capital volatility in this asset class. The GFC, where it again, the credit loss was pretty modest, but it did sell off and recover very strongly and then in 2009 recovered very strongly. And then in COVID, it very briefly sold off from a capital perspective and then recovered back towards par very quickly because of that senior secured status. For the vast majority of the rest of the period, it's a very stable, upwardly sloping return profile and you get your regular income, but there can be this very short-lived capital mark-to-market because you're daily priced at the end of the day, right? So in terms of your question about now versus the GFC, interestingly, the current pricing of the asset class, which is about 92 cents in the dollar today, already is pricing in a similar to a GFC style event in terms of a recession. If you think about it, if you're buying it at 92 cents in the dollar and you're getting paid back at, they get refinanced at par over a sort of a 2 to 3 year time frame on average, then you've just got to think about between buying at 92 and getting refinanced at par, what's my risk of default and recovery on that? And so that's already priced into markets. Markets are pricing in, in the order of 6 to 8% defaults, and yet the last 12 to 18 months, defaults have been about 0.2, 0.3%, so way below that 2.5% average. Sure, we expect defaults to go up to that sort of 2 to 3% long-term average, but that's more than already priced in to the market. So it's always about, sure, we've got the risk of recession coming. We think that these defaults will be more company-specific. Past default cycles have been somewhat industry-specific, whether it be there's periods in time where, you talked about tech wreck, there's been energy crises or, the financial crisis that impacted particular industries. We expect this time it's going to be more company-specific, where it's companies that, over-levered, can't service their debt, can't withstand inflationary pressures, rising interest costs, or the negative impact on EBITDA from recessionary risk. Is going to be quite company specific, but very manageable in terms of the default levels and already priced into the market. So we see upside from the capital front as well as the your regular income that's growing. Now versus the GFC, it's quite a different perspective. So this asset class now has a much more diversified investor base and great support for the asset class when it prices down to certain levels, because you've got some very sophisticated institutional investors that will take advantage of that. So when earlier this year, in first week of July, it traded down about 90 cents in the dollar and quite quickly traded up to 95 and is now back around that sort of 92, 93 cent level. So you've got a much more diversified investor base. You've got more conservative leverage within the corporates, better interest coverage ratios, etc. So for a whole variety of reasons, the asset class is in much healthier shape and the corporates themselves in much healthier shape now than where they were leading into the GFC, which is why we only expect defaults to go up to that sort of long-term average of 2 to 3%.
Yeah, so a lot of people listening to this are particularly people like thinking about an income focus, and I see why you said that in your answer in the icebreaker. Having that exposure to the asset class as an income generation tool, but also in total return terms, because as a collective, have always thinking like, well, for the last 10 years, bonds have only gone one way, which has been good if you've been holding them, right? Like government bonds or whatever. The last few years, some of us have thought, well, we need to shift away from this duration risk. And now interest rates are coming back. Earnings still seem to be holding up in the US in particular. I was looking at FactSet the other day. It's in line with historical averages, which probably makes a bit of sense in an inflationary environment. But then to be able to shift potentially, this is just me thinking out loud here, shifting part of a portfolio towards an asset class like this seems to make a lot of sense from a yield perspective, because it's kind of that middle ground between you're not taking the huge duration risk, but you're getting that floating rate exposure. I don't know. That was just me riffing.
You're spot on. That's exactly why senior secured loans can be so complementary to your more traditional forms of fixed income. So you make the point that historically, over the last few decades, investors have been highly dependent on more traditional fixed rate bonds that have got a lot of duration. So your government bonds, your investment grade bonds. Whereas this asset class is quite the opposite from it. And so the yield on this asset class, as I mentioned earlier, 3-year yield of about 11% currently. That's about 3 times what you're getting on treasury yields in the US. It's about double the yield that you're getting on investment grade bonds, and yet you're doing it at near zero interest rate risk or near zero duration, whereas some of those investment grade or treasury asset classes have sort of 6 to 8 years worth of duration or interest rate sensitivity. And so historically we've been highly reliant on a declining rate environment and government bonds and investment grade benefiting from that. As rates have risen over the last 6 to 12 months, those segments, investment grade and government bonds, have produced really sharp negative returns, whereas floating rate credit like senior secured loans has managed to produce flat to strongly positive returns during that environment. And it's highlighted to investors for the first time in a long time the benefits of having floating rate exposure, the benefit of having a high yield with near zero interest rate risk, and the complementary role that can play within a diversified portfolio. So coming back to funding sources, for a diversified portfolio, we're seeing this asset class funded from the likes of equities and bonds, given that senior secured loans is classified as a sort of a low to mid-risk asset class. It'll be funded from equities and bonds. And in an income portfolio, it's typically funded from hybrids or bonds to provide, floating rate exposure that's more global in nature.
Yeah, it's really interesting because, I deal with a lot of listed products here in Australia, like listed funds and whatever, and there's maybe 10, maybe not even. And so thinking outside the box here, there's a lot more exposure that you can get from this. In terms of that, actually, when it comes to constructing portfolios, just say Invesco generally, we don't need to talk about specific products, but when it comes to constructing portfolios, you mentioned before that in this asset class, diversification is really important because it's about avoiding the losers. Mm-hmm. What's typical in, say, an established fund or structure, but in terms of exposures here, like how many holdings would there be? How many underlying assets?
Yeah, so you're typically talking in the hundreds, so 400 to 500 different corporates. And as I mentioned earlier, there's about 1,500 that are investable. So you've got plenty to choose from, but you're looking to spread that risk across a variety of corporates and industries. Typically, it's your top 100 to 150 corporates that are where you're taking the bulk of your exposures or your active risk. But to give you a sense, largest holdings would typically be in the order of 1 or 2%, because coming back to that point around avoiding losers, in an asset class like credit, where your upside is limited and your downside can be significant in default, you want to make sure that you spread your risk across a variety of corporates, because at the end of the day, you're just trying to pick up the income and the yield, and you want to be paid your $100 back at maturity. So looking to spread that exposure to corporates across plenty of names, which is, as I said, a contrast to an equity portfolio where you might be trying to pick your top 30 to 50 names that are going to produce the best total returns over time. You don't want that sort of concentration in a credit portfolio.
Do you think that these types of products, so I'm talking from a self-directed, most, as I mentioned, most people that listen to the show, including myself, are self-directed investors, and we're looking at managed funds, listed products, whatever. But still, and you've been doing this for a long time, right? And I'm having this conversation now. Do you think that these types of funds and these types of strategies are going to become more prevalent?
Yeah, I think that's right. I mean, obviously private markets and credit investing has been available for wholesale and self-directed investors for a while, but it's great to see the broadening of that. And so, yeah, I mean, senior secured loans is an asset class, as I mentioned, available via managed funds, typically a pretty low sort of minimum to invest via a PDS, or that's available on platforms with no minimums. That sort of access is there. And I think that the access for self-directed or wholesale or retail investors towards private markets and to senior secured loans is just going to grow over time, because what we're seeing on the ground is that there's demand for private markets, and there's demand for diversity across portfolios, going more global, going more floating rate. And so, I see that the opportunity set in terms of access methods to only grow from here for self-directed investors.
I've got maybe just a couple of questions just to tack on here. Did I hear you say correctly, actually, that you think this is one of the better opportunities that have presented themselves or on a forward-looking basis in quite a long time?
For this asset class?
Yeah.
Yeah, absolutely. So I believe, it's been going for over 30 years.
Yep.
And the best entry point into this asset class was during the depths of the GFC. That's when I helped, I did a lot of research into the asset class, the role it can play in a portfolio, and researched about 20 of the specialist senior secured loan managers in the space, and helped Frontier's industry fund client base to build their exposures. That was the best entry point in the asset class, because it was just this technical sell-off that was trading way below fundamentals. It was an obvious upside capital opportunity. The reason I think now is one of the best entry points in the asset class history, and certainly the best entry point I've seen since I got to know the asset class in the 08-09 period, is that you've got, as I mentioned, 7% per annum income that's growing with rate rises, and there's about 150 basis points of rate rises that are still expected to come through that you benefit from. And you've got the fact that it's trading at 92 cents in the dollar, right? So you've got potentially 8% worth of capital upside depending on what defaults transpire. But as I said, I think defaults are going to be a lot lower than what's currently priced in to the market, and will be more in line with historical averages. So I come back to that sort of what that gives you when you allow for 7% income that's growing and your potential capital upside. That's where you get your all-in 3-year yield number of 11% per annum, which I think is a really interesting yield. And in order to have, say, downside to that, even a low return or a negative return, you've got to have a pretty deep recession and significantly more defaults than what's currently priced into the market. So from a risk-adjusted perspective, it feels like a really solid yield with senior secured status in a proven low volatility asset class that has good protections given your entry point of 92 cents. If the entry point was $1, then it would be a different situation, right? But at 92 cents, then I think that's a really compelling risk-adjusted return opportunity over the next, say, 12, 18 months to 3 years.
You definitely got me really interested. So you've done a good job of explaining it. Because this is, I don't want to get too far over myself, but this is something that I've been looking for, these types of things in the makeup of portfolios. And I get a lot of questions about this side of the portfolio. If Drew was in on this conversation, he'd probably call it defensive alts, but and that's kind of how I think about it. But yeah, it's really interesting to get that spread above the cash rate right now. Interesting anyway. So I'm going to go away and do a lot of thinking about this. But I've got one final question for
just one. You made that point around defensive alts. One thing I haven't mentioned is around why I classify as a low to mid risk. So there's three key ways of thinking about risk, I see, right? You've got volatility. So volatility in this asset class is sort of 2 to 5% over a rolling 5-year basis. So about a third of equity volatility, right?
Okay.
So you got low volatility. Frequency of negative return is another way to think about risk. There's only been 2 negative returns in this asset class, in its over 30-year history. The one in the GFC in 08, and then there was a very small negative in 2015 that, interestingly, for an $8 hedged investor was actually a slight positive. So that means you've only had 1 negative in 30 years as an $8 hedged investor. That compares to other forms of fixed rate bonds or equities that have more frequent negative returns. The third way of thinking about risk would be permanent loss of capital. So income drives this asset class. You can have mark-to-market capital volatility, but in terms of permanent loss of capital, as I mentioned earlier, 0.9% per annum on average, given you are senior secured within the capital structure. So that's pretty modest relative to other types of investing where your capital loss can be more significant. So if I summarize that, across volatility, frequency of negative return, and the risk of permanent loss of capital, this is actually a low to mid-risk asset class despite being below investment grade.
Yeah.
Yeah.
Yeah, interesting. My final question for you is, what's one thing that you believe, this is a hard question, by the way, what's one thing that you believe about business, investing, life, whatever, that few people would agree with you on?
So I don't know whether people would agree with me on it or not, but the one thing that I think I use as a philosophy is making sure that in any situation to really focus on the things that matter. And so typically in so many things in life, in investments, in business, in personal life, there's so many different factors, influences or distractions, right? But so often there's really only a few things that really matter. So it's about, in that situation, identifying what matters. And so for investing, clearly, my background, the things that matter to me is strategic asset allocation, diversification, knowing what you own and how it's going to behave, right? So that you can make informed decisions of buying and selling through time and, be a smart investor. But, in personal life, it may be your spouse, your kids, the sport you play, your passion, whatever it might be, trying to avoid the rat race and technology and distractions and really focus in on what matters, because often there's only a few things that really influence the ultimate outcome.
It's really neat, and I've got so many examples from life, but maybe I'll give one to the podcast. And anyone that wants to start a podcast is make sure your guests are great and don't worry about everything else. That's the big one, right? That's the thing that matters.
Yeah.
People spend thousands of dollars on recording equipment and all these types of things, but what matters is making sure you have a great conversation.
Yeah.
And that's and that's so that we can take that in so many different ways. But mate, I really appreciate you taking the time to explain this asset class to us, because it's really got me thinking. When we were thinking about doing this chat, I was like, I don't know anything about this. This is something that for me, I was like, will people be interested in this? But I've found it like really interesting, really illuminating to shine a light on this side of the market. So actually, I really appreciate you taking some time to fill me in and open my eyes to the asset class.
Thanks, Owen. I've thoroughly enjoyed the conversation. As you can tell, it's an asset class I'm very passionate about. So, I think that it is really interesting and a great diversifier for portfolios.
Yeah, great. I'll just, for everyone that's listening or watching, I will put links in the show notes so you can head to the Invesco website to learn more about this, look at insight pieces and all that sort of stuff. Ashley, thanks for taking some time to join me.
Thank you.